Why is global central bank coordination vital for quantitative tightening? Imagine a world where central banks act alone during a process that can shake financial markets and economies. It sounds risky, right? That's why coordination among global central banks is so important when they decide to tighten monetary policy through quantitative tightening. Quantitative tightening involves central banks selling assets or letting their holdings mature without reinvesting, which reduces the amount of money circulating in the economy. This process pushes interest rates higher and tightens financial conditions. If many central banks do this at the same time without talking to each other, it can cause big swings in markets, sharp jumps in borrowing costs, and spillover effects across countries. These effects can hit emerging markets or countries with fixed exchange rates hardest, because they often relying heavily on international capital flows. When central banks coordinate, they can plan the pace and scale of balance sheet reductions better. This helps avoid sudden market shocks and keeps financial systems stable. Coordinated actions also help prevent excessive tightening that could slow down economic growth too much or cause financial instability. For example, if all major central banks tighten together, the combined effect can lead to large losses on assets held by banks and investors globally. This weakens their balance sheets and makes them less willing to lend, which slows down investment and economic activity. When central banks work together, they can share information and align their communication strategies. This makes markets less uncertain about how much liquidity will be taken out and when. It also helps smooth the transition, so markets don't overreact or panic. Without coordination, investors might suddenly reprice risk, leading to volatile markets and financial instability. In practical terms, central banks can coordinate by sharing plans, timing their asset sales, and communicating clearly with markets. This cooperation helps keep credit flowing smoothly, supports stable inflation control, and reduces the chance of disruptive market moves. So, in the end, global central bank coordination during quantitative tightening is vital because it helps manage the risks of tightening policies, keeps financial markets stable, and makes efforts to control inflation more effective and less disruptive worldwide.